This week on Wealth Track, drilling for profits in the energy field. Portfolio managers Gib Cooper of Western Asset Management and Chris Eades of ClearBridge's Investments discover opportunities created by falling oil and gas prices. Next on Consuelo Mack Wealth Track. I began our discussion by asking them how much of a game changer the decline in oil prices has been.
Well, I think it's a game changer only from the standpoint in our market, in the fixed income market, certainly been one of the largest contributors to the oversupply situation. So to the extent that the oil price has declined, that's certainly taken a lot of wind out of the sails of the high yield market in terms of providing capital to energy companies, in terms of activity levels that are declining. So it is a game changer, and we're seeing a real rapid and aggressive response to the oil price within the companies that we research and invest in. So it is a game changer from the standpoint at the company level.
Right.
For the market, I think market overall, it is a little bit of a typical cycle. We think we think that it is not a much different than other cycles we've experienced.
In oil and energy.
In oil and energy,
right.
And we do believe we are biased to a recovery in the price, but it will certainly take time.
So, Chris, just a typical cycle. You've seen this before. Don't get upset by it.
We've done this many times. These are commodity markets. There's going to be volatility. There's going to be down markets. There's going to be up markets. And this, to me, is, despite the severity of it in terms of the magnitude of the decline in the price of oil, it's kind of a textbook commodity correction. The way the commodity markets work, and certainly the way the oil market works, is that if there is more supply than there is demand, that last barrel of oil that's being unsold in the marketplace sets the price of oil for the entire market. And we had an oversupply last summer. Oil prices peaked in August, and obviously we've been in a big downdraft since then, but it's natural given the oversupply that we've had in the market. But I would also note that despite the fact that we've had this decline, some of the self-correcting mechanisms that we typically see to the upside as well as to the downside are certainly at play. As Gib mentioned, we've seen a rather severe change in behavior from the E&P companies in terms of their drilling, in terms
exploration and production.
Exactly, exploration and production companies.
So you mean they're cutting back on their drilling? They're
severely.
Firing people.
In 5 or 6 months, we've seen the number of rigs drilling for oil in the United States decline by 56%.
Wow, they move that quickly.
They do, they do, and that's a short window, and that eventually is going to have an impact on supply, which will help tighten the market up a little bit. And then I think what gets lost on a lot of people right now is everyone keeps talking about the supply side of the equation, demand's responding as well. We are now seeing in the United States significant gasoline demand growth for the first time in 5 or 6 years.
So this decline in oil prices is really hit the high yield market overall, and especially the energy sector of the high yield market really hard, right?
That's correct. Roughly half of our issuers are within the E&P space. Again, the theme within energy, within the high yield energy space is simply capital preservation and liquidity preservation. The name of the game is not grow. Preserve capital, preserve liquidity, and make it to the other side of the cycle.
Right. And that's the mode the companies are in.
That's right. So management behavior is very important to us as fixed income investors. Chris mentioned it early on. Management teams are reacting very aggressively, more aggressively than I think consensus thought they would. They're getting rewarded for not growing, for preserving capital, preserving enterprise value, and waiting for oil prices to perhaps improve over the next couple of years, working off hedged cash flows, retaining capital. And for many companies, that's really preventing them from paying dividends, preventing them from buying stock back. And they're getting rewarded for managing the balance sheet. And that's why it's particularly interesting for fixed income investors. It's an interesting time to invest in the sector.
So the quality of management is going to matter
Absolutely.
A lot to you, but we'll talk about that in a minute. So in the master limited partnership space, where you're investing in MLPs, what's the dynamic there? How have they responded? What difference does it make in the kind of companies that you invest in?
It's a very different world
right.
Than what Gib is talking about for exploration and production companies on either the equity side or the debt side. I'm investing in the infrastructure the pipelines, the processing plants, the storage terminals, those sorts of assets. Those assets, by and large, generate their cash flows irrespective of what the price of oil is or even what the price of natural gas is. What's important for these assets is not the value of the commodity, but the volume of the commodity moving through whatever infrastructure asset it is that we're talking about. That being said, I mean, MLP stocks have been weak. I mean, they haven't had this severe decline that we saw in exploration and production companies, nor as bad as what we saw in the oil field service companies, but they still did decline. I mean, peak to trough, they were down around 20 some odd %, and that would compare to exploration and production companies and service companies, which were down around 50%. So not nearly as painful, but it shouldn't have been as painful because the cash flows that these assets are generating are really largely unchanged. These are often regulated assets. These are assets that are backed up by long-term contracts, fee-based business models, and not really dependent on the underlying price of oil and or natural gas.
And at Western Asset, you actually think that the energy sector of the high yield market is attractive, right?
That's correct. We do. We have generally, broadly speaking, in our funds, both institutional and retail, a healthy overweight to energy at the moment. A lot of that was put on in the last 5 months or so. Certainly, we find that the spread difference between energy and the market today, within the market, we can find very good opportunities that, say, in the 7 to 10% yield area, that provide good current yield as well as potentially good total return opportunities if we're right in that this is a cycle that'll play out over the next couple of years. And oil will necessarily go back to where it needs to be to attract future supply growth.
And infrastructure companies, you think that they're undervalued right now?
Certainly. I mean, we wiped out almost 2 years of gains in these stocks. Yet we have a growth story that's largely not impaired by this oil price environment. So I think it's a very attractive environment, and we've actually been putting some money to work in the space.